How you doing, everybody? This is Kurt Henry at the Mortgage Center, and we are mortgage brokers. We work with multiple banks and lenders just to get them to compete for you to get you the best deal when you're getting a mortgage. And this is a weekly mortgage update to let you know what's going on in the mortgage market. There's obviously been some big changes that have happened or that are coming out that were announced yesterday, and I just wanted to try to add some clarity onto those changes and what they actually mean. It seems that the news is really focusing on one change, but really there's 3 or 4 big changes that are happening. So I'll just go one at a time and try to put some clarity to them. The one major change is, or the first major change is the fact that for insured mortgages, that is when somebody's purchasing a house with less than 20% down, the qualifying rate for 5-year fixed rates and greater now has to be a higher rate. In other words, in the past, if you were getting a $400,000 mortgage, at 2.39% on a 5-year fixed rate, the payment on that mortgage would have been about $1,770 per month. And you could qualify for that mortgage as long as you can qualify for the $1,770 per month. But going forward, the rate, the qualifying rate, has to be around 4.64%. And so the payment on that mortgage would be about $2,245 per month. Not that that's actually going to be your payment, but that's just what they want to see that you can qualify for, even though you're going to have a lower payment. So, for example, that $400,000 mortgage at 2.39%, the payment's $1,770 per month. At 4.64%, the payment is $2,245 per month. So basically, it means that you have to be, in this example, you have to qualify for $475 more. And what that means is if you were pre-approved for a $400,000 mortgage, that pre-approval will decrease to around $300,000 or just under. And again, that's only for insured mortgages with less than 20% down. It can have a big impact. Now, does that mean that everybody has to that has done a pre-approval has to do a new pre-approval? Not necessarily. If their pre-approval was already done based on a variable rate mortgage or a term that's less than 5 years, then they would have already been qualifying at a 4.64% rate. So this is more so aimed at people that were pre-approved for or at the 5-year fixed rate or greater, that their pre-approval could change. So best thing to do is, if you did a pre-approval, just to call the person that did your pre-approval or give us a call, and we can give some clarification on that. The second thing that the major change is for portfolio insured mortgages. That is mortgages that are more than 20% down. So in other words, conventional mortgages, the maximum amortization is going to be 25 years. Now, a portfolio insured mortgage, the problem is with that term is most people don't know when the conventional mortgages are portfolio insured or not. And basically what happens is there's a number of banks and lenders that will have their mortgages insured by CMHC and Genworth, even if there is 20% down or more. But the consumer doesn't normally know that because it's just kind of in the back end. It's also called back end insurance. So what's going to happen is there's going to be a number of banks and lenders that are only going to be able to offer a maximum of 25-year amortizations, even if you have 20% down or more. Not all of the banks will have to do that, but some of them will. And the other thing for those portfolio insured mortgages, again, more than 20% down, they will only allow for them to be used for owner-occupied houses. In other words, not rental properties. And again, it's only portfolio insured mortgages. So some banks will portfolio insure all of their mortgages, and other banks will not portfolio insure all of their mortgages. So it's really just a case-by-case basis. Best way to figure it out is to call a mortgage broker that actually works with multiple banks and lenders, so that they can let you know the difference from one bank to the other. And the third major change is capital gains tax. So generally when you sell your owner-occupied house, you don't have to pay capital gains tax on that sale. So what people were doing is when they were selling rental properties, they would call it their owner-occupied house, and therefore they wouldn't have to pay capital gains tax on those sales. But going forward, the government is saying that they want all sales of houses to be reported on your tax returns, and that includes rental properties. So in other words, if you're selling a rental property, you can't just say that it's your owner-occupied house in order to try to get away from paying capital gains tax. So that's the third change. The fourth major change is more of a kind of a heads up from the government, and that is that they're putting a discussion paper together on how lenders and banks can share in the risk on insured mortgages. So again, that points to mortgages that are less than 20% down. Basically, when CMHC and Genworth have to insure that mortgage, the government wants the banks to have to share in the risk if there is a default on those mortgages. And what that basically means is if there's more risk that the banks have to take on their own, then it will convert into higher interest rates because risk is expensive and it will likely convert into higher mortgage rates. So if you have any questions on any of that, feel free to give us a call. Phone number again here is 905-436-8010. Thanks and have a great day.